Chapter 10, the financial plan. I could lecture on this for 3 days straight and still not provide enough information. The financial plan is easily the most challenging portion for most groups as they put together a business plan. Ironically, this is also a pretty short slide set. However, the chapter has much more details. You definitely cannot do well in this class without diving deep into this chapter reading. So let's try to give a 30,000 foot overview with the understanding that this isn't enough. Now, I'm going to provide a link in the class platform to a resource online that actually does a really good job of breaking down things like break-even analysis. That's probably the most complicated part of this presentation, so I'm going to provide a link for that. But let's look at the financial plan and what it entails. It provides a complete picture of how much and when the funds enter the organization, where the funds are going, how much cash is available for operations, the projected financial position of the firm. Financial plan provides a short-term basis for budgeting and prevents a common problem, lack of cash. Cash flow is so important in new organizations. It's so important in any organization. The plan explains how an entrepreneur will meet the obligations and maintain liquidity, again, cash flow. In general, the plan will need 3 years of projected financial data for outside investors. So you're looking at me as an outside investor in this situation. I need to see your plan in detail for 3 years. That involves a lot of budgeting. So before developing a pro forma income statement, read about that, prepare the operating and capital budgets. It needs to be detailed. So sole proprietors are responsible for all budgeting decisions. A partner or employee may initiate the budgeting process. A sales budget must be developed. Expected sales by month, for example. The entrepreneur determines the cost of these sales. So like your fixed costs, your variable costs, your total costs, right? Include an ending inventory to buffer against demand fluctuations. How are you going to make sure you have enough product or service available? The production budget also allows projected cash flows for the cost of a good produced, including inventory. So you need to have product on the shelves, inventory for being able to provide a service enough hours in the day, that type of thing. This provides actual production needed for each month to meet the demand. So you have a projected demand, be realistic. How are you going to meet that demand? How are you going to not exceed that demand to a point that your costs are going through the roof? It determines how much is spent and for what purposes. This needs to be a well thought out plan. Operating budget and capital budget for operating costs list the fixed expenses and calculate the variable expenses, which will vary with sales and marketing. This budget and the manufacturing budget are the basis for the pro forma statement. So you have to be able to make these little budgets in pieces, put them together to make complete budgets, and then add all the different budgets together to have a financial plan. Capital budgets are used for evaluating expenditures that may impact the businesses for more than 1 year. Again, I want you to target about the first 3 years. New equipment, vehicles, computers, or facilities, be detailed. Decisions may include evaluations of that make or buy decisions in manufacturing. Do we make this or do we outsource it? Do we buy it from a supplier? And the comparison of leasing and buying new equipment. These are two separate things. Do you want to lease a storefront? Do you want to buy a storefront? Do you want to lease a factory? Do you want to buy a factory? What are the advantages of different things and why are you choosing to do it whichever way you do? Enlist accountant assistance for very large products. There again is my advertisement for a good accountant and a good lawyer. Forecasting sales. There are many methods for projecting sales, and most startups rely on the more qualitative methods. To project sales simply and reasonably using qualitative methods, startups in the same industry can provide expectations for their early sales. Local chambers of commerce or business organizations may provide information on expected first-year sales, i.e. how many customers match that. You can even pull census data on how many, let's say, males 35 to 50 are in Spartanburg and Greenville County, and that's who we're going to target. Those are great ways to start. Sales estimates may be wrong no matter what approach used. I get it. That's why they call it an estimate. Estimate sales at several levels are reflecting contingency estimates. That's why they call it an estimate. The pro forma income statement requires monthly projections. Seasonality should be reflected in these sales figures. For example, if you're planning on starting a Christmas tree farm, obviously you're going to do more sales between Thanksgiving and Christmas and less sales, let's say, in the spring. So how does your business operate the other 10 months out of the year? Pro forma income statements. First, calculate sales by month when preparing the pro forma income statement. Cost of sales can be disproportionately higher in some months. Sales revenues for the internet startup may be difficult to project because you just don't know what kind of traction you're going to get. So just be realistic. Don't say, yeah, I think we're going to sell 10 million. I'm going to be like, really? What if you don't sell any? The pro forma income statement provides projections for operating expenses for each month of the first year. Selling expenses as a percentage of sales may be initially higher, so your expenses are at startup a lot higher than they are later, so your prices might be a touch higher to start. Make it make sense for your organization. Cost of goods can be sold, can be an industry standard or computed per unit. You could be in a very competitive market where you're not able to mark up as much as you'd like. How are you going to make it happen? Remember, entrepreneurs are people who solve problems creatively and deliver solutions. Okay, investors prefer projections for years 2 and 3, and that's what I'm looking for. I'm looking for 3 years here on a monthly basis. So we're talking 36 months here. Some expenses remain stable. Otherwise, use year 1 as a guide. I realize the first year, the first 12 months, things will be a little more dialed in than, say, months 12 through 24 and 24 through 26, or 36, rather. Be conservative when projecting your operating expenses. Be conservative when you're projecting what you think you're going to make, too. Pro forma cash flow, it's all about cash flow, baby. Cash flow is not the same as profit. It's the difference of cash receipts and cash payments. It's money in, money out. Depreciation is an expense, reducing profit, not a cash outlay. Okay, keep those separate. 2 standard methods of projection, direct and indirect. The indirect method adjusts net income for cash not yet in or out. I literally want to say, hey, these are the bills we're paying, here's the money we have on hand, here's what we have left for the month. Next month, these are bills we're paying, this is the money we have on hand, this is the money coming in, this is where our position is. And keep in mind, you can't go negative for very long. Now, what you can also assume is, hey, I'm asking this investor for X number of dollars, and this will carry us through these 12, 24, and 36 months. So you don't just say, hey, let's ask for $100,000. No, you do your cash flow and realize exactly how much you need to ask for. Then you make your business look attractive in terms of it's going to provide customers with solutions that they're going to want to buy, and here's how we're going to market it to them. But you come up with how much money you're going to need based on largely your pro forma cash flow. Keep that in mind. The monthly projection of cash is a pro forma cash flow, sometimes called a cash flow statement. When the outflow is greater than inflow, funds need to be secured. That's where the venture capitalist or the bank comes in. This is where you need to bridge the gap. That's why you're asking for money. It's not just some flat fee. You've worked through your cash flow and saying, doggone, we really need $300,000 to make this work for 36 months. See, I'll read that initial paragraph, and then I'll, if that hooks me, then I'll look at that executive, summary, and then I'll turn right to this cash flow and see if what's asked for in the executive summary matches what you actually need and that you've thought it out. If that all makes sense, then I read the whole business plan. That's how it works. So again, a cash flow. Invest large short-term sources of positive cash flow. Negative cash flows are likely for a new venture, so estimate conservatively to cover the negative cash months. That, again, allows you to know how much to ask for. Revise projections. You got to justify it, right? Revise projections and provide scenarios based on different sales levels, because you could do 3 scenarios. Here's low sales, here's medium sales, here's high sales. Here's what we definitely know we need. Okay? If you're being conservative, you look at the low sales and you're saying, hey, worst case scenario, we're successful, just not successful at the level we want to be. Here's how much money we need. Likely scenario, the average, here's how successful we are, and here's the money we need. And then we're going to kill it and get you a return on your investment, which I would love as your venture capitalist to be able to do, but that may not always happen. So be realistic on your cash flows. It's incredibly important. Everybody hears about the balance sheet, but it's really the cash flow that makes things go around. Now, long run, you need a balance sheet because you hope you grow your company into a corporation, sell stocks, and then everybody's looking at your balance sheet. The pro forma balance sheet reflects the company's position at the end of year 1. So we got cash flow from month to month, and at the end of year 1, here's my balance sheet. Assets represent everything of value owned by the business. Current assets include cash, anything convertible to cash within a year, i.e. stuff you can sell, like a building, equipment. Fixed assets are tangible and used over a longer period of time. Liabilities represent everything owned to creditors, meaning owed to creditors, really. Current liabilities are owed within a year, and unlike long-term liabilities. Owner's equity is the excess of all assets over liabilities. Owner equity represents the net worth of businesses. Any profit is included in the net worth of retained earnings. So again, make sure you're going through this. Now, one thing I'm definitely going to want to see is a break-even analysis. And this can get a little bit technical. This is why I'm going to provide a simplified link alongside this video. So look in the description. There'll be a link there. This is a technique to determine how many units need to sell to break even. So where do we get from the red to the black? Sales that must cover the fixed cost obligations. So in the short run, as long as you're covering your variable costs, you stay open, if you remember that from macroeconomics. Break even is the volume of sales, rather, at which the business will neither make a profit nor incur a loss, and you're covering your fixed and your variable expenses. So the break even formula, you get the BE times some quantity, so how many do you need to sell, your total fixed cost divided by, and make sure you do this, your variable cost per unit. So you take your sales price, SP, and minus out your variable cost per unit. Because remember, in the short run, you stay open if you're covering your variable cost. If you remember that from macroeconomics, you know what? I'm going to link another lecture that I did in an economics class for small businesses during the pandemic that explained why you look at variable costs in the short run. So I'm going to include that along with the simplified example for our break-even analysis. So you take your total fixed cost, which is your variable cost plus your fixed cost, and divide it by your sales price minus your variable cost per unit. Now, variable cost per unit is costs that you incur if you operate. If you don't operate and there's costs, that's called fixed costs. Now, your sales price includes, as a form of cost, how much profit you want to make. So you put in like your physical variable cost, your physical fixed cost of every cookie you're going to make, right? But you also include, hey, I want to make a 20% margin here. And that's included in your sales price. So a weakness in determining whether a cost is fixed or variable, well, can be confusing what's fixed and variable. So basically, if you're operating and you have a cost that wouldn't otherwise be there, that's a variable cost. If a firm produces more than one product, allocate fixed costs to each product, then you can calculate the break-even point. Long story short, if you're only making one product, your fixed cost per unit is really high. If you're making 1 million products, your fixed cost per unit is pretty low. Adjust variables such as price to see if the impact of the break-even and profit. Basically, what it's telling you here is play with us a little bit. And again, I'm going to provide a link to an example that simplifies this because, again, this lecture is not sufficient enough. I definitely got to do the reading, but I really feel like this is where you're going to have to spend some time because I want to see a sharp break-even analysis. Pro forma sources and application of funds. The pro forma sources and application of funds statements show the disposition of earnings from operations and other financing. Its purpose is to show how net income and financing were used to increase assets and pay off debt. So if I'm going to give you this money, what are you going to do with it? It's often difficult to understand how net income of the year was disposed of. Typically, sources of funds are from operations, new investments, long-term borrowing, and sales of assets. So how is your money coming in from where? Major uses or applications of the funds are to increase assets and retire long-term liabilities, reduce owner equity, and pay dividends, you hope, in the long run. This statement emphasizes the interrelationship of these items to working capital. Now, sometimes you can get some help for this with software packages. There are several financial software packages that can track financial data and generate important financial statements. Spreadsheets are the easiest and most widely used, like Microsoft Excel. You need to know everything you can about Microsoft Excel. Probably, other than human capital, probably the most important tool to most businesses. Using spreadsheets in the startup phase can help present different scenarios and what-ifs and contingencies and assess their impact on pro forma statements. It's a great spot to start gathering all your information in one place. In the startup stage, when the venture is small and resources are limited, software can be simple and easy to use. Most allow you for check writing, payroll, invoicing, inventory management, bill pay, credit management, and taxes. Things like QuickBooks is what I'm talking about here. It's one of the easiest to use. Or you can just get yourself a really good accountant who employs a bookkeeper for you. I think it's worth every penny so that you can focus on your product or service and delivering value. All right, again, that was I'd say 30,000 foot view. That was an 80,000 foot view of a financial plan. I'll provide some additional resources alongside this video in our course platform. Hope you enjoyed the very quick lecture. This is the most challenging, so of course they would make a very short slide set for it. But anyway, get to work. See you next time.